All right, folks, I wanted to talk about something really important, and I want you to have, it's one thing to talk about indicators and patterns and all of this stuff, but sometimes you want to know a little more. You want to have a little different view of what's going on in the market, and I want to try to offer that to you. So you're probably thinking, what in the world is a word dog doing in front of our face? Usually you got some, charts and market data. It's earnings season. But I want to show you something, and I want to talk about this, and I want you guys to pay close attention. You're not going to find this information very easily, and I want you to start thinking using that mind of yours. So the U.S. stock market, the total value of the U.S. stock market is roughly, give or take, we're not forensic accountants here, okay? It's roughly $34 trillion. Now, how does that shake out? Who's buying? Who's selling? Who's doing the... Retail investors, 30%. Mutual funds, 25%. Pension and retirement funds, 15%. International investors, don't forget about international investors, 15%. Hedge funds, long, short, hedge funds, equity-only hedge funds, long and short, remember that, about 10%. ETFs, 2.5%, there's a lot of ETFs there, and high frequency, multi-strategy, all the other stuff that's relating to the stock market, about 2.5%. Now again, some of these numbers will change, some of them won't, but what you're seeing here is pretty much what it is. This is the landscape of the US stock market. Now, why are stocks moving higher? Well, retail investors, according to the latest data polls, they're pulling money out of the market. They're not investing greatly. Mutual funds, they're in bonds, a lot more money going into bonds than last year, this time of year. Pension funds, I thought, my theory was that it was pension and retirement funds. I'm always thinking there's more money rolling into it and they're just reinvesting. But I looked at the latest data, and again, you're not going to get this information anywhere, so pay attention. I looked at the latest numbers, and guess what? They're also taking money out of, they're diversifying, they're putting their assets outside of the stock market. Nothing wrong with that, but they're playing defensive right now. But this is my theory. I think it's a good theory. Average hedge fund, long, short, equity-only hedge fund, earned I think it was 15.2% in 2019. The stock market gained 31%. What does that mean? That means if you were in a mutual fund or a hedge fund, not a mutual fund, a hedge fund, you would have to pay 2% plus 20% of any of your gains. That's the usual, 22. That's how it works. When I was in the business, that's what we got. I don't remember if it was 22, but that's the benchmark, 22. 2% is a fee and 20% of the gains. That's the cost of being in a hedge fund. Usually hedge funds outperform the S&P or they have much lower volatility. None of that happened in 2019. So a lot of investors, a lot of big investors, to be specific, about $180 billion worth of money is upset right now. And that amount of money has been short. Now, being short in 2019, market gained 31%. Not a really good idea, right? That means $180 billion lost a lot of money. That's how much money was in short U.S. long, short hedge funds. $180 billion. I'm getting granular here. So they still have to pay that 2%. Obviously, they didn't have to pay the 20% because they didn't outperform the stock market. They did bad. 15.2%, 15.1% on average among all the funds. I needed to get this data. This is why I waited till the end of the year to do this. I just got this data. So my theory is this group right here, this hedge fund group, they're playing catch up right now. And they're going to, it's not easy to put $180 billion back into the stock market. First, go long to exit the short and then to go long. It's a two-step process. Both involves going long. So $180 billion going from a short position to a long position is what I believe is causing the stock market right now to go higher and higher and higher. Because all the other categories that you see here, retail investors, mutual funds, pension and retirement funds, international investors, and ETFs and all the others, they're not allocating more capital to the stock market. So my theory is hedge funds are playing catch up. And if that's the case, they're going to continue playing catch up for another 2 quarters. And you know what $180 billion coming into the stock market, turning around the other way means? Upside, a lot of upside. Hope that helps. Folks, pay attention, this is really important. Now, I look at several factors, including tracking what institutional investors are doing with their money when I map out what the markets is likely to do next. And I recently published all of my predictions for 2020 in a market blueprint that accounts for all of the what ifs that could happen this year. And the best way, I mean the best way to profit from each possibility. That's why I'm super confident that I can double my entire account in 2020. I've got a trading roadmap and the right strategies to crush this market, no matter what happens next. If you want to get my predictions, click the link below. We're already 3 weeks into 2020, which means this is your last chance to get your hands on the blueprint. Do it now.